what if I told you a stock trading under $9 could surge to over $18, potentially doubling your money in the next 6 to 12 months? Welcome to Smart Stock Sam, where we deliver data-driven stock analysis you can actually use to make informed investment decisions. Today, we're diving deep into ONDS stock, Ondas Holdings, to answer the critical question everyone's asking. Is this beaten-down autonomous defense play a genuine buy-the-dip opportunity, or should you cut your losses and exit now? By the end of this video, what I'm about to reveal might completely change your perspective on this overlooked company. Here's what you absolutely need to understand about Ondas before we go any further. This isn't your typical drone company anymore. We're witnessing a fundamental transformation into a global autonomy platform with defense contracts backing real revenue. The company just reported a backlog explosion of 180%, and they're sitting on a pro forma cash balance exceeding $1.5 billion. But here's where it gets really interesting. There's a hidden battle raging beneath the surface between short sellers and institutional giants that most retail investors are completely missing. This tug of war could be the single most important factor determining where this stock goes next. Now let's talk about the strategic pivot that changed everything for Ondas. The old ONDS was primarily focused on industrial wireless communications and rail utilities, solid businesses, but not exactly explosive growth territory. Fast forward to today, and you're looking at a completely different animal. The new ONDS is a kinetic defense powerhouse operating at the cutting edge of autonomous warfare technology. They've strategically moved from small pilot programs to standardized defense procurement, making aggressive acquisitions of companies like RoboTeam and Rotron Aero to dominate multiple segments. We're talking autonomous demining systems, clearing dangerous terrain, tactical robotics for ground operations, and lethal loitering munitions for precision strikes. This isn't just incremental change. This is a complete business revolution, positioning them squarely in the fastest-growing defense segments globally, right as military budgets worldwide are prioritizing autonomous systems. Let's get into the actual numbers, because this is where the story gets truly compelling. Take a close look at this revenue trajectory. We're looking at a massive jump from just $16 million in 2024 to a projected $180 million by 2026. That's more than a 10 times increase in revenue in just 24 months. And here's what really matters. Management didn't just meet expectations in Q4. They absolutely crushed them so hard that they actually raised their forward guidance. We're talking about nearly $30 million in a single quarter, which exceeded analyst estimates by over 50%. This isn't speculation or hopeful projections anymore. They're proving in real time that they can execute at scale and deliver on their commitments. The critical question for investors isn't whether this company can grow. They're already demonstrating explosive growth. The question is whether the market will wake up to this fundamental shift before it's too late to get in at these depressed price levels. So where exactly is all this massive revenue actually coming from? Is this just promotional hype and optimistic projections, or is there genuine substance behind these numbers? Let me walk you through the boots-on-the-ground execution that's backing up these growth projections. First, they've secured a $30 million demining contract in Israel. This is real money being deployed right now for real defense operations, solving one of the most critical security challenges in conflict zones worldwide. Second, their counter-UAS systems are being actively deployed at major international airports as we speak, protecting critical infrastructure from drone threats. Third, and this is absolutely huge for future government contracts, they just received coveted Blue List approval for their Optimus drone system, which effectively clears the regulatory path for widespread federal U.S. government procurement. These aren't speculative opportunities or maybes. These are signed, binding, multi-year defense tenders with governments and major institutions. The revenue pipeline isn't a question of if, it's purely a question of when the cash flows through. Now here's where this story gets fascinating from a trading perspective. If the fundamental news is so bullish, why has the stock pulled back recently? This is what most retail investors miss, and it's creating one of the most asymmetric setups in the market. We're sitting on a technical powder keg. Short interest is at 27% of the float. More than 1 in 4 shares is sold short by bearish traders. But look who's on the other side. Goldman Sachs just filed showing a 4.2% stake, while retail shorts bet against ONDS smart money at Goldman is accumulating. This divergence creates squeeze fuel. When fundamentals catch up to technicals, the move could be explosive. The macro chart tells a clear story. On the weekly time frame, the trend remains bullish, 340% year over year. This pullback is a technical test of trend support. Healthy bull markets pull back, shake out weak hands, and resume uptrends. Big money accumulates at these moments. The chart shows a higher low forming. On the daily chart, the entry is clear. Price is compressing into a demand zone between $8.70 and $9. RSI at 41, approaching oversold. We need volume confirmation at this support floor. This is textbook low risk, high reward. The market's handing you a discounted entry on accelerating fundamentals. The options market reveals big bets. There's a massive call wall at $10, acting like a price magnet. Market makers position for a move back here, with put support at $7.50. Smart money isn't betting on collapse, they're betting on a rebound. Options flow confirms the fundamentals. Sentiment divergence is telling. Retail is fearful, volume below average. Classic exhaustion, where individuals capitulate at the bottom. Wall Street analysts rate it strong buy with an average target of $18.37. That's over 100% upside from $9. Be greedy when others are fearful. The crowd panics while professionals load up. For the equity play, entry zone $8.70 to $9. Stop loss at $7.75 below the 200-day moving average. First target is $10.50 gap fill. Big target is $15.28 retest of highs. Risk $1 to make 6 or more, better than 1 to 5 if we hit the home run. For leverage with defined risk, use a debit spread. Buy the $10 call, sell the $12.50 call for March. This reduces cost and fights time decay. Defined risk play for a high probability move to $10-12.50. Professionals don't gamble. They create strategic positions with favorable odds. The risks that could invalidate this: execution risk. Revenue is milestone-based. Delays create volatility. We need Q4 at 27 to 29 million confirmed. Integration risk. Rapid acquisitions of Rotron and RoboTeam create operational friction. Technical invalidation. Break below 750 on volume kills the bull case. That's your line in the sand. When's the next catalyst? March earnings. We need Q4 revenue of 27 to 29 million confirmed, plus updated 2025 guidance. Hit those numbers, and it de-risks everything for the milestone payments in mid-2026. Timeline is compressed. Months, not years. Now, before I give you my final take, here's the mandatory disclaimer. This analysis is for informational purposes only and does not constitute financial advice, an offer to sell, or a solicitation to buy any securities. All investments carry risk, including the potential loss of principal. Past performance does not guarantee future results. Options trading involves significant risk and is not suitable for all investors. The data presented is based on publicly available sources, believed to be reliable, but not guaranteed for accuracy. You should conduct your own due diligence, understand your risk tolerance, and consider consulting with a licensed financial advisor before making any investment decisions. I am not a financial advisor, and you are solely responsible for your own investment choices. My bottom line: ONDS presents a classic inflection setup. Transformational pivot, accelerating fundamentals, technical support while retail panics and institutions accumulate. Compelling risk-reward if you accept execution risks. This is a calculated bet they'll deliver on guidance, and the market will recognize value. For aggressive investors with proper risk management, this is asymmetric opportunity. If you found this valuable, subscribe and turn on notifications. We break down high-potential stocks weekly. Comment below, Would you invest in a stable company with modest returns or take a calculated risk on a high-growth story like ONDS? Thanks for watching Smart Stock Sam. See you next time.